Canara Bank has reported a 12% uptick in profits while its net interest income took a hit. My colleague Shubhana spoke to the MD and CEO Satyanarayana Raju on the numbers.
Immediately, we are given a guidance of initially when we commenced that financial year with our NIM, we expected that it may be around 2.90 in anticipation of flexibility and the liquidity in the second to third quarters. But in reality, that we are not seeing that. Gradually, quarter on quarter, the demand for the deposits, the higher rate of interest is ruling the market. So that has costed for us very much in that cost of deposit become gradually increasing quarter on quarter. That has impacted our NIM. Though we effectively managed our yield on advances, that has considerably increased. But the deposits is a major concern. Cost of deposits is a major concern. That's why we could able to manage in the 9 months period at 2.83%. In a conservatively, we are telling that we are given a guidance that by March we may be at 2.80. The reason behind that is in the January month itself, again the bulk deposit rates are ranging between 7.9 to 8%. That's a too high cost. That's why we are focusing more on retail term deposits as well as in the CASA. Of course, CASA is a little bit of concern, but the retail term deposits we are focusing so that we can garner the business at comparatively a lower rate of interest.
Okay. But going forward with the interest rate cycle on the horizon and, as deposit pressure continues, what is the medium-term plan? I mean, 2.8% is for the current financial year, but going forward, as we step into the next financial year, what are your plans over there?
I feel that even if the same liquidity continues in the market, if the same tempo continues, the NIMs will be only on that around 2.75 to 2.8%. We cannot expect to go 2.90 or like that because the reason behind is the cost of deposit became a big issue. And nowadays, because the payment systems have been matured, every individual using a mobile app and the net banking. So when they can transfer that amounts on their fingertips, even by sitting at their office or the home, even at 24 hours, so they can change whenever they want to. Either they can transfer the funds, surplus funds to fixed deposit, or they can, whenever they want, they can redeem those fixed deposit. This flexibility has come to the depositors. Earlier, for any of the transactions, they used to depend on the branch. That's why they used to keep more than enough required the surplus in the CASA. But now they are not keeping more than required in the CASA. And it's because they can even overnight within no time, if they want the surplus money, they can prematurely close their FDs online and they can credit back to their SB accounts. That's why they are keeping only minimum required balance in the CASA and the remaining balance they are diverting to the retail term deposits. That's why term deposits garnering is not a major concern for us. But for us, concern is only a CASA. Term deposits, if you offer a little bit more rate of interest, you can garner it. Just to maintain our NIM, just to maintain our costs on the resources, we are given a guidance of 9%. We are growing at 8.5%. So March quarter, we are sure that we will cross that 9%. So when the initial stages of the financial year, whatever we are given, advances we want to grow at 10%, we are growing at 10.54. And deposits, we are given a guidance of 9%. We are sure that we will grow at 9% so that our CD ratio will touch the 77%.
Sir, you spoke of loan growth and deposit growth. I wanted to divert the conversation there. I mean, a lot of banks have been, recalibrating their loan book and, are cutting down on their, loan growth and deposit growth for the next financial year. Kind of wanted to understand, while you are confident of meeting these targets by the end of this financial year, but going forward, will you stick to the same in FY26 or you would like to, recalibrate your position there as well?
So in predicting the market, I feel that the Canara Bank is little advantage we have that. When we announced the last year financial results, and we are given a guidance to the market that we grow our advances at 10% and the deposit at 9%, market has received that we are conservative. But it has come to the reality and we are able to surpass that whatever the guidance given to the market, not like other banks. So that's why our expectations, our assessment is near to the reality. We expect that the next year also credit growth can be even 10%. And because now we are reaching to the optimum level at CD%, so we may have to garner the deposits also at 10%. That's the only thing. That's incremental growth, whatever the business, that CD ratio should not be, incremental CD ratio should not be more than 100%. That we ensure in our business planning.
Hmm. All right. Sir, also wanted to move the conversation to asset quality now. Your NPAs have declined and, asset quality continues to improve. You don't have as much exposure to personal loans or microfinance for that matter. But, provisioning seems to be high. Could you throw some light on that as to, what are the factors that are leading to high provisions and to what extent going forward, you will have to, provide more provisions going forward?
If you look at the industry, the best banks, they are able to reach to that, especially peer banks, the top 5 banks, they are able to reach that provision coverage ratio at 95 to 97%. We are still at 91%. So there is a scope for reaching to that position. It is nothing but a strengthening your own balance sheet. When you have scope and when there is a steady growth in the net profits and all, when you have an excess profits, that is better to keep as a provisioning. So if you look at that in the current year also, our provision ratio has increased from 89% to 91.26%, almost 225 basis points. So our work will continue to increase further in that till we reach the 95%.
Okay. All right. Sir, also wanted to understand, the impact of the liquidity coverage ratio norms. These are draft norms and these are likely to come into the next financial year. There have also been talks that, the RBI could differ on these norms or, could change the, earlier format. Wanted to understand how is the bank coping with, the current, tight liquidity conditions and what could be the impact of these LCR norms on Canara Bank?
So whenever regulator comes out with any draft guidelines, being a reporting entity, being a banking, one of the leading bank, our job is to see that we prepare for that, facing that. So that's what actually we did, that when we have draft guidelines have come, it is expected to implement from 1st April onwards. We assessed our impact on our LCR. It is working out around 11 to 12 basis points. As on date, our LCR is at 123% as against the regulatory requirement of 100%. Canara Bank itself is having internal ceilings of 105% at a minimum threshold limit we have to maintain. See, even if you observe that 11 to 12% the impact of new guidelines, if you implement even as on today, after implementing that guidelines also, our LCR will be above the 110%, which is above the regulatory requirement, even bank its own policy requirement. But we don't want to be happy with that. Again, we want to recoup and rebuild that LCR, because LCR is always a strong point for us to meet the emergencies, anything is there. That's why in the December quarter, we have come out with 2 more time slots. That's the term periods made, that there is a term deposits. We have created 2 more slots. That's a 2 to 3 years and a 3 to 5 years. These blocks we created, there we offered a higher rate of interest. If it is a 1 year, it is 6.85. 2 to 3 years, we offered 7.3. And 3 to 5 years, we offered at 7.40. So the higher rate of interest, because longevity in the term will be useful for our LCR, so that we can strengthen our LCR. That has naturally, once you increase the term deposit rate of interest, garnering term deposit is not a big issue for government banks, especially bank like Canara Bank. And last 1 month, we already garnered 8,000 crores. And we will continue to do up to March 31st, so that again, we want to bring it back our LCR, even after implementing that guidelines, new guidelines, we want to keep our LCR around 115 and above.